Market guest in Rahul Arora joins in from Nirmal Bang Institutional Equities. Rahul, hi, good morning. We'll talk about the overall market setup in a bit, but I was just looking at your report, so I really have to ask you about two stocks which we haven't discussed at length over the last few times. One is Apar Industries and the other is Westlife, which recently was quite active.
Yeah, so I think we're very positive on both, Anuj. I think I'll take Westlife first because, as you know, we've been very positive on the urban discretionary for some time now, since December of last year. I think the franchise is fantastic, Anuj. So Westlife basically covers the west and south part of McDonald's in India. They have about 200 stores. Why we like it is we think this business could essentially be 5x over the next 10 years. What I mean is the potential for McDonald's to have 1,000 stores in India is far more than a Domino's to have more than 2,000 stores. Okay. The price points are lower. I think you can't look at this stock on a PE basis, Anuj, because it was a loss-making company.
That is what I was asking you. It's very expensive stock.
Right. It will be because there is no E. But I can give you various examples, in large cap companies or even mid caps like Crompton's or Bajaj Electricals, where you see a loss-making business that goes into a profit and the market likes that. You can't value this company on FY16. It'll make a loss this year as well. But our call is that the same store growth for this company in FY17 and 18. And as you know, most of our discretionary stocks are valued on 18 because you have to factor in at least one leg of the revival. And that there's no point looking at a discretionary stock if you want to look at it from 6 months to a year or even a 2-year horizon. I still think that if you can hold this stock for 2 to 3 years, it could give you 70 to 80% kind of returns. It would, on our numbers on FY18, be trading at 30 times. By no means am I suggesting that it is cheap. It is expensive. But as Warren Buffett once said, a great business will not come at cheap prices. And in a strange sort of way, most of the stocks that we like are expensive stocks. But I think the fact that the margin expansion in this way, we're expecting it to be very huge, is huge operating leverage, Anuj. I think the supply chain that Westlife has with McCain globally. And we've done a lot of groundwork on it. I mean, you try their fries vis-a-vis a Burger King. It's so much better. I mean, just product quality. McCafe is a new entrant into the business, which is a product extension of what they anyway do. Delivery is something that they want to take up to 20%. And when you hike your delivery, your return on capital employed goes up that much more. So I think that is a very, very interesting part of the business, McCafe and delivery. And if you've gone through any of the ones recently in various tier 2 and tier 3 cities, it's trying to open drive-thrus as well. So I think it's a great story from a return on capital employed perspective. Very inherent strong business fundamentals, very strong supply chain. Don't look at valuations on this because once you start getting the earnings in FY17, 18, the valuations will take care of itself. Something like Just Dial when we used to speak about a year and a half back. On Apar Industries, Anuj, I think the conventional business that they've been doing on cables has sort of been coming down. If you look at what they're doing, they're getting into elastometrics. They're getting into optical fiber cables. This is a company we think over the next 2 years could give you about 150 crores worth of free cash flow. It's got very strong return ratio profile expectations over the next 2 years. In fact, we expect the ROE and ROCE of this company to go up by 500 to 600 basis points over the next 2 years. It is one of the few companies that is giving you the return ratio profile at an under 10 PE. You'll have to really hunt the market for that. So I think if you are ready to hold on to this stock, you'll still probably get 30-35% returns from here. It is one of our top picks in the capital goods sector. We also like Triveni Turbines and TD Power Systems, as you know. But I think if you have a long-term horizon, Apar and Westlife could be. And you would have noticed Westlife recently saw some pretty interesting institutional activity as well just a couple of days back.
Okay, Rahul, since both stocks have rallied, you want to make any upfront disclosures on any of the names?
None of my analysts, nor me, nor my firms or associate firms hold any stake in these companies. We've just recommended them to clients.
Okay.
Let's come to the other recommendations, staying with the capital goods space. You've picked up Triveni Turbine as well as TD Power. Now, these stocks did well last year, but this year the run has not been good. In fact, TD Power has lost 35% since the beginning of the year. What makes you like them?
So I think, Reema, one of the apprehensions was with the way Europe was going and the way the euro was behaving vis-a-vis the dollar, that TD and Triveni, which both have a very large exposure to Europe, their export competitiveness would essentially go down. But if you take a look at the last 3 months, the euro versus the rupee, we've actually depreciated substantially vis-a-vis the euro. That sort of takes care of that concern. Now, in TD Power Systems, they had entered the EPC business over the last 2-3 years, which had actually suppressed their return ratios and was actually forcing them to report a loss. They have just about 5 to 6 crores worth of orders left in the EPC business, which they will book in this quarter. Once that's done, you will find that from FY17 onwards, the margin profile of this company will jump from 2 to 3% to as much as 14%. And the ROEs and the ROCs of this company, which are below 5%, will go to the range of 15 to 20%. Again, TD Power Systems has 270 crores of cash on its books. We're expecting 150 crores of operating cash flow. Going at under 10 PE for those kind of return ratios, great company. Triveni Turbines, again, it's a product company, much like TD Power Systems. We love product companies. The reason for that is they operate on negative working capital. And whatever order book you have at the 1st of April of any particular year, you are very sure that it will be executed on that year because they operate against advances. Triveni rather goes at about 22 times. So I think for a capital goods space stock, you can say it's probably expensive. But I think, again, free cash flow, 50% ROEs. I mean, which capital goods company in India gives you that? So I think great long-term stocks to be holding both of them.
Yeah. Okay, two stocks, any temptation to book profits in CCL products? And second, SKS Microfinance, you have top pick on that. Recently there was a bit of a scare with one brokerage report and we did see the kind of big decline in stock price. So what's the call here?
So I'll take the second one first, Anul. Generally, I don't tend to read other brokerage reports, but I read that one particularly, and it sort of coincided with the fact that the market was down 1,700 points that day. So you saw an accentuated fall in SKS Microfinance. It's a very well-held stock, so it's not surprising it saw the kind of fall that it did. Now, when you're looking at this business and you're looking at the huge underpenetration of microfinance in this country, and if you read the recent reports that have come out from regulators on microfinance, I don't see why this company should not be growing at 40% its AUMs as well as its disbursements for the next 2 years. It's a company that has a 25% ROE and a 5% ROA. Private sector banks don't give you that. I don't know why you would want to sell this stock. I think the correction is actually giving you a very good opportunity to enter. The return ratios are strong. The earnings profile is strong. And like I said, I think as per our calculation, the penetration is like, probably in the low double digits. So there's a huge scope for SKS Microfinance to grow. On CCL, Anuj, I wouldn't be tempted to book profits because the stocks come back from 250 to 210. If anything, I would look to add because it's given you a correction and it's been such a phenomenal story. And we keep telling our clients that, even though it's the erstwhile consolidated coffee, it's not a commodity company because he doesn't have the plantation risk like McLeod Russell does. He's a simple converter. So if I'm CCL products today and my client is essentially placing an order with me, I will order my beans just in time. So I don't even carry an inventory risk. So if I look at my EBITDA per kg over the last 10 years, regardless of what's happened with coffee prices, my EBITDA per kg has simply gone up. Again, despite the run that it had at 250, it was going at 15x. I think at about 210 or 215, whatever the price is right now, it's probably come off a lot more. Again, a 25% ROE company. You'll find this common thread, Anuj, in most of the stocks that we cover. We only look at stocks that will probably be 20-25% ROEs that are cash flow generating. This company will give you close to 250 crores cash flows in the next 2 years. It's an industry leader. We love companies that are industry leaders. You would remember Colgate and P&G. So I think any dip you get to buy into a CCL products, and if you're ready to hold on to this company, and if it gets the FMCG kind of valuations, someday somebody could come and say, hey, this deserves a 20p, from whatever, 13, 14p that it is today. And from the current market price, you could easily get 60-70% if that call is taken. And that call will not be taken by a retail investor. It will probably be taken by a large institutional investor. So I think both on dips should definitely be looked at in terms of adding.
You like retail plays. You've got a buy on both V-Mart Retail as well as Arvind. Is it a top-down approach or you've selected only these two in the retail?
No, I think the financial profile is very different for both these companies, Reema. V-Mart Retail is essentially a tier 2, tier 3 player. If you look at their stores, there are 110 stores and almost 70% of them are in Uttar Pradesh and Bihar. They follow a cluster approach. So their costs are half of Shoppers Stop, Trent and Pantaloon because it doesn't make sense for these guys to open there because of their ticket prices. And because their costs are half, their margins are double. And this is one company that actually gives you consistent operating cash flow, and that actually takes care of their capex. It's a debt-free retail company, very few that you get. And again, at the risk of sounding repetitive, again a 20% plus return ratios company. On Arvind, I think the call is more on the brand and retail play, Reema. I don't think we're too enthused about the textile business because I think eventually the brand and retail piece will demerge itself over the next 3 to 4 years, and I think a lot of institutional investors will probably be playing for that. Our understanding is, just to give you a case in point, Gap, and I visited the Saket store towards the end of July, and it had already done for 29, 30, 31st May and all of June, and the first few days of July, it had done in excess of 10 to 12 crores of sales. That's a huge opening for something like a Gap. And if it can give you 50 to 60 crores in this financial year from one store, this could be a 500 crore brand that you're talking about in the next 3 years. It's already got Polo, Tommy, Arrow. It's got 4 power brands, and this could land up being one. So I think the metrics are totally different. This is to be viewed, and our call is that the brand and retail margins will expand from 5% to 8% over the next 3 years, 100 basis points every year. Great price. Arvind's corrected from 350 down to 220, and then it's gone up again. So it's been a fairly volatile stock. But if you get it anywhere between 220 to 250, it's a great buy. V-Mart, I think there's tremendous upside in that stock.
There is a possibility they'll spin off the brands and
We believe so. It's not something that I can confess that the management has given us guidance for, but I think it's probably the only logical thing to do given what they've done with Arvind Infrastructure, because I think they'd probably... So what's going to happen is that the operating cash flow of the textile business is going to fund the brand and retail venture. And I think once the brand and retail venture, once he has 6 or 7 power brands under the fold, which he already has 4, Gap and a couple of others that come through, I think it's only logical for that part of the business to be trading separately. So who wants to buy the brand and retail will buy it separately. Who wants to buy the textiles will buy it separately.
Okay. Finally then, a large cap, Hero MotoCorp.
Right.
It's not in the top list of a lot of brokerages, but you like it.
It's a contra call, Anuj. I like that and ITC both as contra calls. Hero, I think, will give you about an 8% kind of CAGR on the top line over the next 2 years in terms of volume growth. We're expecting about 200 basis points margin expansion. If you see...
It's only one product is working right now, and that makes it a bit
but
vulnerable.
it's still gaining. So you're right in that he's lost a lot of market share in scooters. But I think if you look at the new launches, my analyst believes that the market share gains will be quite substantial from here. He's still the market leader in motorcycles. I think that's something that has not dented.
But that's just one motorcycle with no margin.
Fair enough. But I think if you speak to the management, they'd give you guidance of the fact that they're looking at launching 2 or 3 new products. So I think the call here is 3 or 4. One is their Project Leap, which is actually adding substantially to their margins, between 50 to 100 basis points every year. The other is that he's gaining market share in motorcycles, and we're expecting him to gain market share in scooters going forward because he has about 2 or 3 launches that are in the pipeline. Third is just the general benefit of lower raw material prices. And if you want to look at two-wheeler penetration, Anuj, it's not even 45% in India. So we may think that you see a lot of bikes on the road. The fact that there's an entire huge, large market that's not even penetrated. So I think it's coming to you at about 13 times Hero MotoCorp on a nifty company that's probably going to give you 25-30% earnings CAGR over the next 2 years. It's a very brave call for someone to take right now, but I think it would be a very, very good contra call. I remember we discussed ITC at 290 and I said that could be an interesting contra call as well. So I think these two could actually, from the large cap space, be interesting ones to look at. I think we're very positive on Hero's earnings especially.
All right, Rahul, thanks a lot for joining us. Rahul, of course,